I'm John Heinlein, CEO and Senior Portfolio Manager at Horan Capital Management. Welcome to our 2018 second quarter market commentary video. The broad market climbed higher in the second quarter on rising earnings stemming from sound economic data. U.S. stocks, as measured by the S&P 500 index, performed well, rising 3.4% during the quarter. The Russell 2000 Small Cap Index had an even stronger performance, rising 7.7%. On the other hand, foreign equities, as measured by the EAFE Index, did not perform well, as they declined 1.96%. During the second quarter, the Federal Reserve raised the Fed funds rate another 25 basis points. The Fed funds rate, a leading indicator, has now reached 2%, up 75 basis points this year and up 175 basis points since 2015. It has long been feared that this Fed-driven interest rate tightening cycle would mark the end of the economic expansion. While rising rates aren't typically an investor's preferred environment, the economy appears supportive, and 2% rates is still a historically low level. The current economic data looks promising. The unemployment rate stands at a 17-year low of 4.1%, despite a tight labor market where job openings continue to rise. In addition to the healthy job market, housing starts continue to climb, which are fueling construction jobs and demand for materials. Corporations continue to buy back shares and raise dividends, further boosting the wealth effect. This wealth effect bodes well for consumer sentiment and should aid consumer spending going forward. Looking out to the second half of the year, continued economic tensions with China are front and center on Wall Street. Whatever the long-run benefits of attempting to level the playing field with respect to trade and intellectual property, investors are uncomfortable in the short run, which is causing some market uncertainty and volatility. As we start the second half, many investors will be keeping a close eye on company second quarter earnings reports. Expectations are generally high, as lower corporate taxes and an advancing economy should lead to positive reports. Of course, with the bar set so high, individual disappointments are likely to be greeted harshly. Therefore, we will closely be watching for long-term opportunities if they should arise. Headlines will likely be dominated by politics for the remainder of the year. Rhetoric on both sides are getting more contentious, and as midterm elections draw closer, there could be a potential fallout on Wall Street if there are any economic policy implications. At the present, investor confidence is somewhat murky considering the potential disputes with China and other trade partners. Despite these risks, the market continues to show resilience, and we continue to keep a watchful eye for possible headwinds that could disrupt businesses that we own or are considered to purchase. This concludes this quarter's market commentary. Thank you again for your time. Next, Lewis will provide some closing remarks.
Thanks, John, and thank you for watching this quarterly market commentary. As always, we take into consideration many of the economic factors that John described when they complement our bottoms-up investment approach. So for example, John mentioned that individual disappointments during earnings season could potentially bring some harsh reactions in the markets. And in this case, when we feel that we have a sound understanding of the long-term earning power of the business, we look to take full advantage of those short-term disappointments and price movements. We continue to seek high-quality businesses in any economic environment, and we're firm believers that a financially sound company with a strong economic moat can overcome short-term obstacles and become a long-term staple in your portfolios. Thank you again for your time, and if you have any questions, please do not hesitate to reach out to your financial advisor. We look forward to seeing you next quarter.